Welcome to Markets Now. I'm Michelle Rook along with Ted Seifert with Zaner Ag Hedge. And we did have a lower day except for soybeans and feeder cattle futures. Joining us is Ted Seifert. And Ted, let's talk just a little bit about first of all, the Fed rate increase of 0.75%. That was pretty much anticipated by the trade. And talk about how we reacted to that and what it means longer term for money flow.
Yeah, leading up to that announcement, there was about an 80% confidence that it was going to be a three-quarter of a percentage hike, 20% confidence thinking that it might only be a half a percentage hike. So the fact that it was split even just a little bit made you kind of think that when they did go three-quarters of a point, that maybe that would be bearish for the stock market and a little bit bullish for the dollar index. However, if you read the wording of what the Fed says when this announcement comes out, the wording is a lot more friendly towards pausing or possibly slowing down the bigger increases, the bigger hikes that we have been seeing. So, because we trade futures rather than today's, Michelle, we're looking towards the future, thinking maybe this interest rate, the bulk of the interest rate hikes or aggressive interest rate hikes might be behind us at this point. And that was really very positive for the stock market. That was really very bearish for the US dollar index. And ultimately, that could be really quite positive for commodities. Now, that announcement came out as or right after the grain markets were closing, and certainly after the livestock markets closed. So we haven't been able to see the effect of that on the agricultural markets. But you would think that the big drop in the dollar and even to some extent the strength that you see in the stock market might translate into some positive headwinds for commodities as a whole, including the agricultural markets.
Yeah, well, we've been so caught up in recessionary fears and money flow out of commodities as a result. Hopefully this can reverse that trend. So the other big news headline today was obviously Russia saying that they're going to resume the grain export deal. So corn and wheat, basically, we took out or war premium, I should say there, didn't we?
Yeah, we sure did. We put it back in. We put it into the markets one day, and then we took it out the next when Russia was, only just kind of very briefly out of the agreement, I suppose. And actually, as the day went on yesterday, when they said, we're just pausing the agreement, we're not canceling the agreement.
Yeah.
It didn't get the feeling that that was going to last, but it only took a day. So yes, it would make sense that you put the premium in when it was off, and then you take it back out when it's back on again. I'm going to say this, though, Michelle. If Russia didn't completely get out of the grain export corridor deal when their warships were attacked in Crimea, then I don't know what it would take for them to completely walk away from the deal. I don't think they're going to, short of some nuclear escalation or American boots on the ground, something like that. So I think the last 2 days really just kind of proved that grain export corridor is going to be there. That is going to be intact, even though Russia did say that, we might exit again. But if we do exit again, we're going to leave in place shipments going to Turkey because, Turkey's been very neutral and they've worked well with Turkey. Well, here's the thing about that, Michelle. All of the ships have been going to Turkey for inspection by the UN. So how would they be able to tell the difference between ships bound for Turkey as their final destination versus ships that are going to carry on and ultimately go somewhere else? So I don't think that Russia is going to be able to make any attacks on any merchant vessels in the Black Sea region, which means insurance companies should feel better about that. And again, I think that export channel is going to continue to stay open.
So we went down, we filled those chart gap areas, we kind of held support here. So where do we go now in corn and wheat from here?
Yeah, good question, Michelle. It would be an easier question to answer if we had some clear direction going on before this week happened, but we didn't. All we've been doing is going absolutely sideways. In corn in about a 25-cent range. There's a lot of buyers at $6.75. There's a lot of sellers at $7. So very, very sideways. And again, with the news on and off or whatever, we're really back to square one. So now we're looking for some sort of something to break us out of this range one way or another. And maybe it comes from another geopolitical issue or something like that. I mean, look, in the last 4 or 5 years, we've had things flying out of nowhere on a very regular basis. So we certainly can't write that off. However, Short of something like that happening, the next real big thing is South American weather. That's what we're going to be watching very closely. We've already started to do that. It's fairly neutral. Yes, so there are some dry areas, but planting in Brazil is going fairly well. There's a little bit of concern about Argentina, but they have gotten a little bit more rains lately, and maybe that's an overall change in the weather pattern. So it's very mixed markets, very murky fundamental inputs to these grain markets right now. So again,
Okay.
very much sideways. Now, the one exception to that might actually be soybeans.
Yeah, let's talk about that because soybeans, we got above some key moving averages. So is this a technical move or are we getting pushed by soybean oil or other factors like China maybe relaxing this COVID policy?
There's a couple good things coming together for soybeans sort of at the same time, and it's translating into some better technicals, right? And that's often how it happens is, fundamentals would be the spark and then technicals kind of carry things through. But yes, China relaxing or potentially relaxing their zero COVID policy and really opening up fairly aggressively. The idea there is that that will bring more demand really for lots of different things. I mean, the cotton market's really responded well to that too. Crude oil's responded well to that also. But specifically people going out and eating more maybe, so pork demand, therefore soybean meal demand, therefore soybean export demand from us. These are all positive things that could potentially be for the soybean market. But on top of that, you've got, the election going on in Brazil, a movement towards more of a socialist regime, socialist government policy. And the concern there is that you're going to have a lot of workers' unions really striking. We're worried about a lot of port strikes, trucker
Right.
strikes, things like that. I mean, Brazil always has these sorts of problems. And we're already seeing that. Protests are blocking the road to their second largest port, the port of Paranagua. And if that continues, that could really cut into their export abilities in the near term, which might mean more business for us. So
Does it push us up to
those two
15, you
things.
think?
Well, technically speaking, so that's how that works, right? The fundamentals gave us a reason to kind of try to go higher, but then in the last 24 hours, we've been able to break through this sort of downward trend line that we had been in, and now that we're back above that, you have more upside potential. But to your point, there are a lot of highs between 1480 and 1520, so that's going to be the next big nut to crack. I think that's going to depend on whether we do, in fact, see these bigger export sales happening in the near term. How concerned is China about the logistical issues in Brazil? Are they going to step up to the plate and be aggressive buyers, even at higher prices? If that's the case, then yes, 1520 will be a target that I think could fall pretty quickly. If they step back and buy less on these higher prices, suggesting they're not concerned about the long term of the logistical issues in Brazil, then again, I think we're still stuck in this sideways trade range that we've been in since the quarterly grain stocks report at the end of September.
All right. Well, thanks for your analysis as always. Ted Seifert joining with Zener Ag Hedge. That's Markets Now.